Well, there's been a lot of talk lately about an oil shock breaking the system and silver being the next thing to go absolutely vertical. So in this video, we're going to separate signal from noise. And you're going to walk away a lot clearer, a lot calmer, and a lot more prepared for what may actually be coming. Today is Friday, April 17th in New York, so comment the day and date you're watching from. And real quick, if you value straight analysis like this, subscribe and comment John A.G. Best. That helps more than you know. Now, in case you've seen some of the panic floating around, the basic story goes like this. Energy gets hit, shipping gets jammed up, fertilizer gets squeezed, food costs start leaning higher, inflation refuses to cool off, money gets nervous, and then eventually a chunk of capital starts looking for something real to hide in. That's the chain people are staring at right now. And on the surface, I get why that sounds explosive. Because the world does not run on screens. It runs on fuel, it runs on fertilizer, it runs on metal, it runs on parts that have to be mined, refined, moved, financed, insured, and delivered by actual people using actual infrastructure. That's the part modern markets like to forget, right up until they can't forget it anymore. What makes this moment interesting is not just that oil has been volatile. Oil is always volatile. What makes this moment interesting is that the stress is showing up unevenly. The benchmark price says one thing, the physical market says something else. One region looks manageable, another region looks tight. One buyer still has optionality, another buyer is paying whatever it takes just to keep the lights on and the trucks moving. That's where the conversation gets serious. Based on recently published numbers, the Strait of Hormuz has been handling more than a quarter of seaborne oil trade and roughly a fifth of global oil and petroleum product consumption. So when that artery gets disrupted, this is not some side issue on the edge of the map. This is a pressure point for the entire machine, and that pressure does not hit everyone the same way. The United States has buffers, it has reserves, it has alternative barrels, it has domestic production, it has room to absorb some of the blow. Europe and Asia do not always get that luxury. Recent market reporting showed U.S. sour crude staying relatively contained, while physical barrels headed into Europe and Asia were pricing dramatically higher. That's a huge tell. Because once the physical barrel starts trading with a panic premium, you are no longer talking about a neat paper market story. You are talking about urgency. You are talking about buyers who don't care what the screen said an hour ago. You are talking about what I call survival bidding. And once survival bidding shows up in energy, it rarely stays in energy. It bleeds into freight. It bleeds into petrochemicals. It bleeds into fertilizer. It bleeds into food. It bleeds into inflation expectations. And then, very quietly at first, it bleeds into investor psychology. That's the part a lot of people miss. They think the move begins when everyone is already terrified. No. Usually the move begins when the public narrative is still arguing over whether there's even a problem. Now let me add a little balance here, because this is where people can get carried away. Does every disruption mean the whole pricing system dies tomorrow morning? No. Not even close. Big systems don't usually collapse like a light switch. They fray, they reroute, they improvise. They hide damage behind inventory, policy response, emergency releases, accounting tricks, and wishful thinking. They can limp for longer than people expect. But that doesn't mean the damage isn't real. It means the damage shows up in layers. And that layered effect matters even more in agriculture right now. Recent reporting has shown fertilizer markets tightening again, with sulfur prices jumping hard, and U.S. farmers already shifting acreage because fuel and fertilizer costs got uglier. In some parts of the world, the issue isn't even just price. It's whether suppliers will quote cleanly at all, and whether shipments arrive when they're supposed to. That should get your attention, because if energy stress lasts longer than a headline cycle, you don't just get more expensive driving or airfares. You get tighter crop economics. You get lower application rates. You get smaller margins for farmers. You get lower confidence in future output. And once food joins the inflation story, central banks have a real problem on their hands. That is not theory, by the way. A senior central bank official said just this week that the war-driven energy shock is already feeding into airfare, groceries, fertilizer, and broader inflation pressure. In other words, the pass-through has already begun. So now ask yourself a very simple question. If inflation stays sticky because the real world is short of necessary stuff, what exactly are rate cut dreams worth? That's where the next layer comes in. A lot of investors were hoping this year would be easy money again. Lower rates, smoother growth, risk assets cruising, everybody acting like the hard part was over. But recent reporting shows the bond market hasn't exactly been celebrating that fantasy. Yields have stayed elevated, and even with stocks near highs, fixed income has been much less convinced that this inflation pulse will fade on command. That split matters. Because when stocks are cheerful but bonds are cautious, somebody is probably underestimating the cost of real-world scarcity. Now let's bring silver into this, because this is where the story goes from important to potentially outrageous. Silver is not just a precious metal story, it's a monetary metal. It's an industrial metal. It's a trust metal. When people trust the system, silver can sit there looking neglected, half financial, half industrial, always waiting for its turn. But when the system starts looking shaky from both directions, from inflation on one side and supply strain on the other, silver gets very interesting very fast. And here's the fresh backdrop that matters. Based on the latest industry research, the silver market is on track for yet another annual deficit, which would make it about 6 years in a row. Physical investment is expected to jump sharply this year, and recent reporting also noted that hundreds of millions of ounces have already been drawn down from inventories since the early part of this decade. That is not the profile of a market drowning in abundance. At the same time, recent vault data at the end of March still showed a very large pile of silver sitting in vaults. So this is where we need to be adults about it. Large inventories do exist. Not every ounce is unavailable. Not every stress point means immediate failure. That's the skeptical side. And it matters. But here's the catch. A big pile is not the same thing as a free pile. Metal in vaults can be spoken for. Metal can be tied to investment products. Metal can be strategically held. Metal can be available in theory and unavailable at the price people want in practice. Those are two very different things. So when someone says, relax, there's still a lot of silver in storage, my answer is always the same. Okay, how much of it is truly mobile? How much of it is truly for sale? How much of it comes loose if investment demand rises while supply growth stalls? That's the question. And the supply side is not exactly comforting either. Mine supply is never something you can ramp overnight like flipping a switch. A big chunk of silver comes as a byproduct from other mining activity, which means silver supply can suffer even when silver itself is not the main decision variable. If costs rise, if acid gets tight, if energy stays expensive, if base metal operations slow, silver doesn't get a free pass just because investors suddenly want more of it. That's why I think the cleaner way to see this is not paper bad, physical good, as if it's a cartoon. The cleaner way to see it is this. Paper pricing works fine until physical urgency starts setting the tone. Once urgency takes over, the paper market has to catch up, sometimes slowly, sometimes violently. And silver has a history of doing this in a way that feels almost disrespectful to anyone who thought it would move politely. 1 minute it's sleepy. Next minute it's jumping in big chunks and people are pretending they saw it coming the whole time. Now, does that mean silver goes straight up in one line from here? No. That's not how real markets behave. In fact, one of the easiest mistakes to make right now is assuming every bullish thesis has to play out instantly. It may not. The process could be messy. There could be pullbacks. There could be rule changes. There could be periods where the paper market looks perfectly calm while the physical side quietly gets tighter underneath. That kind of divergence can last longer than people think, but when it closes, it tends to close hard. And let me sharpen the Asia point for a second, because this is not just a vague over there issue. Recent reporting from global institutions said Asia is especially vulnerable to this kind of energy shock because the region leans heavily on imported fuel from the Middle East. That means the places most dependent on stable flows are the very places that can be forced into aggressive bidding when flows get interrupted. Once that happens, cargoes don't necessarily go where they were expected to go. They go where the urgency is greatest. And if you think that kind of scramble clears up the minute headlines soften, not so fast. The head of a major energy watchdog said this week that lost Middle East energy output could take around a couple of years to recover. That is a very different message from the casual assumption that everything just snaps back the moment diplomats smile for a camera. Recovery in commodity systems is usually slower than the damage. That's why I keep saying the real issue is not one dramatic day. It's the aftershock. It's the lag. It's the way strain stays in the pipes long after the headline cools down. And we're already seeing hints of that in precious metals trade flows too. India, one of the world's most important silver importers, briefly saw bullion orders jam up over a government clearance delay, leaving meaningful volumes stuck heading into a key festival period. On its own, that does not prove a global squeeze, but it does show how quickly delays and demand can interact when a market is on edge. That is how stress compounds, not with one giant explosion, with friction. With delay, with rerouting, with buyers paying up, with sellers getting choosier, with inventories looking comfortable until the wrong kind of demand arrives. That is why I don't think the smart takeaway is blind panic. The smart takeaway is respect. Respect for replacement cost. Respect for delivery risk. Respect for how quickly sentiment changes once the screen price stops feeling real to the average buyer out there. And that's why the oil piece matters so much. Oil is the messenger. Oil is telling you what happens when the physical world stops being patient with the financial world. If you're successful, share your success story in the comments so others can stay motivated. Now think one step beyond silver itself. If energy stays expensive, if food gets firmer, if inflation lingers, if central banks can't ease as aggressively as people hoped, then the giant pile of financial assets starts looking a little less comfortable. Not all at once, maybe. Not in one dramatic stampede, but enough to matter. And commodities are tiny compared with the ocean of money sitting in bonds, stocks, and property-linked assets. That asymmetry is the real monster under the bed. It doesn't take all the money moving. It barely takes a sliver. A small reallocation out of paper comfort and into real things can have an outsized effect because the destination market is so much smaller than the source market. That's why repricing events feel nonlinear. They don't move in a nice, smooth staircase. They gap, they lurch, they overshoot. That's especially true when a market has already been lean for years. And that brings me to the key distinction I want you to remember. This is not just a story about panic. It's a story about credibility. When people start doubting that benchmark prices reflect real-world replacement cost, confidence begins to leak out of the system. When confidence leaks, hedging changes, inventory behavior changes, purchasing behavior changes, capital allocation changes, and eventually price changes. That doesn't mean every wild forecast is right. It doesn't mean every shortage headline becomes a moonshot. And it definitely does not mean you should root for market failure, because chaotic failure is not the dream scenario people imagine. Disorder brings freezes, interventions, policy reactions, and confusion. Clean repricing is better than broken plumbing, but a fair repricing of scarce real assets, that is a different conversation. And that conversation is getting louder. So here's my view. The oil shock matters. The fertilizer angle matters. The inflation pass-through matters. The bond market hesitation matters. And silver matters because it sits right at the crossroads of all of it: monetary anxiety, industrial usefulness, tight inventory psychology, and a market structure that can look liquid right up until it suddenly doesn't. That is why people are watching it so closely. And that is why I think the bigger risk is not that nothing happens. The bigger risk is that most people wait for perfect clarity, and by the time clarity arrives, the easy part of the move is already gone. Do you think this stays mostly an oil story, or does it spread into a full real asset re-rating? And what's the one signal you're watching closest right now? Because the next phase may not announce itself politely. It may show up in premiums, it may show up in shipping, it may show up in farm input costs, it may show up in bond yields refusing to cooperate. And then one day, people will look at silver and say, hold on, why is that moving like that? By then, the answer may already be obvious. This is for education and market perspective only, not personal financial advice. I'm laying out how the pieces may fit together so you can think more clearly, do your own homework, and make decisions with your eyes open.